Hello, my name is Michelle Butler, Portfolio Specialist at Cohen & Steers. Today I'd like to talk with you about global listed infrastructure as a hedge against unexpected inflation. I'll cover three topics. First, listed infrastructure's historical relationship to unexpected inflation. Second, inflation-linked infrastructure revenue drivers. And third, near-term subsector opportunities that highlight the importance of active management. But first, a bit on the macro backdrop. The potential for rising inflation and how to protect investment portfolios in that environment certainly appears to be the topic du jour these days, and it's understandable. We've been living in a subdued inflationary environment for some time, really up until this year, but we're now seeing signs this backdrop is changing. While we've seen a significant pickup in year-over-year inflation of late, that's a result of base effects, and really not surprising given the lockdown the world was under a year ago and the ensuing progress we've made to date thanks to vaccine successes and a corresponding pickup in economic reopening. However, we view that rise in near-term inflation as more transitory and rather have our sights set on long-term inflation pressures that we think will play out over the course of several years. We continue to believe consensus expectations for long-term inflation are underestimated. We've seen a massive amount of global monetary and fiscal stimulus that has and continues to be deployed in an effort to accelerate the recovery. Central banks, and the Fed specifically, indicating a willingness to let inflation run hot, likely keeping interest rates lower for longer, and spurring continued government borrowing at low financing costs. Given these factors, we believe the risks to long-term inflation are tilted to the upside. Like many real assets, infrastructure has historically had a strong positive correlation with unexpected inflation. We measure unexpected inflation, or inflation beta, as the difference between the current year-over-year realized inflation rate, so actual inflation, and the prior year's consensus inflation expectation. When we look back historically, we can see that infrastructure tends to perform relatively well during periods of unexpected inflation, so when inflation has surprised to the upside. In contrast, that's typically when equities and fixed income lag. If we looked at different time periods, the trend and trajectory would be similar, with infrastructure generally outperforming stocks and bonds during periods of unexpected inflation. Now, why is that? Revenues for infrastructure companies are often tied directly or indirectly to inflationary trends. The specific revenue model may vary by infrastructure subsector, but the majority of infrastructure assets receive contractual adjustments to user fees that provide either fixed annual increases approximating inflation or variable increases directly linked to consumer or producer price changes. Transportation-oriented concession-based agreements for toll roads and airports, as an example, allow for annual local inflation-linked price increases. In contrast, utilities, whether we're talking electric, gas distribution, or water utilities, operate under a regulated business model whereby periodic rate cases reflect inflationary cost impacts. And that allows utilities to ideally pass through higher costs in the form of higher rates over time. So infrastructure companies may have different revenue models depending on the subsector, but most have inflation linkages and characteristics embedded within their structures. Interestingly, in the short term during inflationary periods, similar to what we've seen this year, it's the cyclically economically sensitive subsectors that actually perform the best, and we can point to the first quarter of this year as evidence. Inflation often surprises to the upside when economic momentum is strong. So it makes sense that GDP or economically sensitive subsectors like freight rails, marine ports, or even midstream energy with its indirect relationship to commodity prices will do well in that environment, and that's exactly what we've seen year to date. Take freight rails as an example. Freight rail volumes have benefited from the recovery of the goods-based economy, driven by increasing online orders and a broader trend in inventory restocking. Over the cycle, we expect all infrastructure businesses to do well during inflationary periods, largely because of those inflation linkages in their revenue models that I just talked about. But in the short term, we have seen the subsectors that in some cases have the least formal inflation linkage actually perform the best because of their economic sensitivity during periods of strong growth. In summary, aside from the compelling fundamentals, relative valuation, and the long-term key themes of data decarbonization and the travel recovery that we've been talking about all year, and which we believe have a long runway of opportunity benefiting this asset class, the macroeconomic environment is duly supported for global listed infrastructure. Infrastructure has historically delivered inflation sensitivity when needed, and we believe the signposts are clear and the setup is occurring now for long-term inflation to surprise to the upside, underpinning a secular, not just near-term, inflation regime change. And in our opinion, that warrants a closer look at what we believe to be a very attractive opportunity for a global listed infrastructure. And with that, thank you for your time today, and please reach out if you'd like to discuss further.